Listings have doubled in the DC area since DOGE has started firing federal workers. So today we're going to discuss how that's going to affect DC and how that possibly could implicate the rest of the nation.
Yeah, it's just the beginning. I'm telling you now, obviously DC is going to be the most impacted because it's regional, and I think I read like 11 or 12% of everyone in DC is a federal worker of some sort.
Right.
So obviously it's going to affect them first, and I think I read 75 to 80,000 people said they were just going to resign as part of that deadline. But now come the next waves.
Well, yeah, on Friday they let go of another 9 or 10,000 people, and in DC, there's 8,000 homes listed for sale. 4,000 of those are in the last 30 days. What's good to note is a lot of these are homes that are over $1 million. So that is good to know because it only affects part of that market. But then, federal workers are all throughout the country.
Well, the other thing I found was really interesting as we were digging into this over the weekend was how high they're paid.
Yeah, the average federal worker makes $106,000.
That's a lot.
Mm-hmm.
So, and then, of course, we were having fun with this. We went back and said, okay, how many federal workers were hired in 23 and 24? Now, whether you agree with this or not, it's going to happen anyway. So I think we have to look at it from a real estate perspective. And certainly we're seeing this is a very short-term impact so far. Like this is the very beginning. This is the first or second inning.
It is. I think something interesting to note is 18% of the new jobs in 2024 came from the federal government, and they were hiring about 30,000 people per month.
Yeah.
So while that may have propped up the economy the last couple of years, because the government was the biggest employer under Biden, these cuts are going to affect, the job market for sure.
The reason we want to discuss this today, because this is just a few months worth of, right? I mean, if you really take a look at history of what we've been hiring. Now, the real question is where's this headed? Obviously, I think I looked at the median price of homes was $699, which is pretty high in the DC area, and now they're in the high fives.
Right, because of all the additional inventory.
Right. So this is precisely what we were talking about before, where you just add inventory. You add, a supply to an existing market. This is regional, but this is very interesting to watch. You should keep your eye on this because this could spread to other areas. I started to dig into what other federal offices, what are federal buildings, because Trump's even talking about potentially eliminating the leasing and selling some of these buildings.
Okay, so you're like jumping all over.
All
so
right.
let's talk about the jobs first, right? So this impacts an area big time because it's not just the federal workers. So as Ken said, this is going to mostly affect DC, but it also can spread out throughout the country. Because Jerry, if you can pull clip 1 for us of where the federal workers are predominantly located, you see, you have quite a bit in, Texas, California, like a bunch of, states across the country. So this could really affect a lot of different regions. It's not just the federal workforce, though, because when you have an area like DC, and Jerry, you can take that down, and you have so many federal workers in an area, it's all the service jobs too, right? Like they go out to eat, they get their nails done, they get their car washed, they get all these things done. So it's going to affect the general economy of DC quite a bit and spread throughout the country as well.
Yeah. And I think while I do believe that this probably will impact the DC area the most, it certainly looks like it will. I don't think that I think this is far from over. Like we obviously they hit the USAID stuff, and now they went into the Department of Education, and now they're going to go into all the others. But the reality is think about this: if an employer shuts down in a town, like it's 500 or 1,000 people, it's a significant impact to a town. So you have to think of it that way as they start to pull back and start to eliminate some of these positions. It's going to affect everything. It's going to affect real estate. It's going to affect rent. It's going to affect consumer buying habits. And then we I guess we should talk about the work from home, right? Because a lot of these folks, and that was originally what he said, was that no more work from home. So that kind of forced a lot of people who had already made decisions to be somewhere else. So this is going to make the people that are looking for work, it's going to be even harder, because I would say a lot of these people are pretty educated. A lot of them are pretty qualified. Now, I think you could swipe a pen and say none of them are, but that's just not true. The reality is there's going to be a lot of mistakes made here too.
Yeah, and I think it's important to note that not all these people are getting let go that are moving. So a lot of people moved because they could work from home, or at least hybridly. And so now if they're going to be in the office 5 days a week, that's a lot for them to commute with their new residents. So you're seeing some people that are going to sell and potentially buy something else. So you will see a little bit of that as well. Something else that's interesting to note is Elon and Trump are both really big on these federal leases. So the federal leases from the federal government take up 10% of DC's commercial real estate. So 10% of the office is taken up by the federal government. They're trying to pull a lot of these contracts back. So that is already going to put stress on an already stressed office market, especially in the DC area, but really nationally, because, our federal government rents buildings nationally, and you would think that would be a super solid lease if you were a landlord. But now it's not. Right.
Well, I think that's going to be the next wave. Obviously, they're not going to do that first. They're going to try to see.
Well, they've already canceled some leases.
They have. But I do think I think this is going to be something that's going to roll through all year, right? And as I started to dig into this, you start to take a look at. There's a lot of federal offices. We kind of we drive right by them. We don't really notice them anymore, right? And state and federal, I guess. But the reality is that there's a lot of from the IRS to Department of Education to various types of Social Security offices and things like that are all over the place, right? I was looking in Salt Lake City. I was looking in Atlanta. We're looking in Phoenix. We're looking at all these other places. I'm not saying that they're going to eliminate those, but I do think they're going to start to look at these on a national. They have to look at these on a national scale, especially if they start cutting back and they have regional offices. Obviously, some of these things that we've already seen that they've cut, they definitely have regional offices.
Yeah, absolutely. And Eli had a good question on YouTube. He says, has the government firing yet equaled all the hiring from the past few years? And I would say no, because they added 30,000 jobs per month last year.
Not even close.
That's 120,000 jobs. Yeah. Right now, we have 75,000 people that have resigned, and we have another 10,000 that have been let go. So, it's going to take some time, but they're really just trying to figure out who's needed, who's not, what's needed, what's not. What's interesting, though, is a lot of these federal office leases are in 10-year contracts, right?
They are, yeah.
And there's been some talk that Trump might say, what are you going to do about it?
Well, yeah.
Because technically, you would need to ride out at least the contract, but I don't know if they're going to.
It's the same thing Musk did with
right.
Twitter when they came back from COVID. We said, come work from home. There's a bunch of big commercial office landlords. We did a whole thing on this. We had a commercial landlord from San Francisco come and not specifically talk about Trump, but just talk about the amount of tech people that didn't come back during that period of time. They were at that time, it was all work from home and they were vacant. The Twitter thing was obviously a little bit different than that, but still, that office market is not even close to recovered.
Yeah, and it's interesting too because this could potentially hurt the credit of the U.S. is what I was kind of reading. If they walk away from these leases, obviously that's going to hurt their credit as an overall
to who though?
Tenant,
who cares?
But right,
like,
to
right,
who? So
like,
yeah.
To who?
Right.
Right.
So, but it could really affect the office market in the DC area, also nationally.
Oh, without a doubt. Office is already trash, right? Like nobody's lending on it. The commercial regional banks are going to, it's going to be very interesting. If you really cut into this, you have somebody that owns the building, might be the government, might not be. You have a lot of times a loan on there, right? So that's attached to a regional bank. No more rent as an example. And then, of course, you're going to start to see some of these hit the market for sale. Obviously, there's going to be a lot of people trying to figure out, when just from personal experience, when I've owned office buildings, you can't have somebody move out of an office building and then just have somebody move back in like a house. Right. Somebody's going to have needs, right? And first of all, it's not a great time to be moving. Ironically, we are moving our offices today. Oh, ironically. So anyway, I think that it's not always going to be able to be moved right back in, right? Like there's going to be a fair amount of work that needs to be done.
Absolutely. And if you look at but also you have to think, is it really just the Doge creating the housing market increase? Because if you look at the Phoenix area in the last 30 days, we've increased inventory for about 15%.
Yeah.
So while it's not doubled, it's still part of this increase is just generally inventory is going up nationwide.
Right. And I think, for our purposes, here's what we want to talk about mostly. We can go on and on about the layoffs, and we can go on and on about how that's going to be. But what we do know right now is the home prices have gone down because listings have gone up.
Right.
And we do know that there's potential ripples in the rental market too, because obviously a lot of these people rent. And so you're going to start to see concessions up. You're going to start to see flat rents. You're going to start to see 1 month, 2 months concessions. You're going to start to see vacancies, and you're going to start to see all those kinds of things. So that is, as I always say, as you guys, as you know, real estate doesn't do well without people. And so as these people start to get displaced and they start to figure out what they're going to do, maybe they stay in the D.C. area. Maybe they move from a house into a rental, which is good for the rental market. But maybe they just move. Maybe they go somewhere else. So who knows?
Right. So some of that could be good for other areas, right?
Correct.
Other areas with growing economies, if they're going to leave D.C. because maybe they don't have a job there any longer, they're going to move to where their job is or where they want to retire depending on their age.
Right. And this in a weird way, this has actually happened with the fires with California. We're starting to see those now in Arizona, and we're starting to see those in areas like Las Vegas, which is where we are investing as well. We have employees there. They're starting to see people do that. We saw that during COVID. Mm-hmm. During COVID, when people, when we locked down, people decided, you know what, I'm not going to go back into the office. I'm going to go move here. I'm going to move there. So this could be, similar, right? Where they go back and they try to figure out where they want to land, where they want to be. And that could be anywhere.
Yeah, absolutely. And it's just going to be interesting as we see kind of this shift in, where people are working and what people are doing. And this is going to create some mobilization. When people start to lose their jobs and have to find new jobs, you're going to see people move for work, especially in an economy like this.
I also want to point out there's a lag here. Mm-hmm. There's a big lag. What we're seeing now is listings went up by 4,000, right? Mm-hmm. That's a lot, guys, for one submarket. It's double.
It's double, yeah.
So listings doubled in a month, right? And those were just the people that decided that they were going to leave voluntarily. So that's that. Now, the question is, what's going to happen when those people leave, right? And where are they going to go? And, what's that going to continue to do to the D.C. market if there's continued people that are also going to be laid off? So you got to look at all of those things. And from a real estate perspective, it's not good for commercial office. It's not good for apartments. It's certainly not good for single family.
Well, and people are kind of commenting on here that this is a nationwide thing. And it is. But what you really have to look at, though, is how heavily D.C. is leveraged in government workers, federal workers, right? So yes, there's going to be layoffs in Arizona. Yes, there's going to be layoffs in California. All over, there's going to be layoffs. However, it's such a big percentage of DC's market as far as jobs. And that's why it's a really big deal. And that, Ken talks about, when you pick a market, you kind of want to pick a market that has a very diversified base for employment, because if you're just relying on the oil business, or you're just relying on, military, or just relying on anything like that, and they pull out, then you're kind of left holding the bag. Now, nobody would have thought that the government would make these kind of cuts, but they are. So that is going to affect DC real estate. It could be pretty impactfully. We'll have to see.
Well, guys, I've been following this kind of stuff for years. These big mega trends. As you guys know, I was managing properties in the Tri-City of Eastern Washington, and when they decommissioned a nuclear power plant, and there was like 11 or 12,000 people. It just completely decimated that particular area. I've managed properties where they've actually closed military bases, right? And there was some administrations that have done that. Completely decimates everything. So I'm talking about supermarkets. I'm talking about apartments. I'm talking about off-base housing. I'm talking about all that stuff. And then of course we see it with employers as well. So when Boeing moved out of Seattle years ago, I'm from the Seattle area. They moved their headquarters to Chicago. It completely changed the market for a while. Now it rebounded, of course, but so this is just nobody ever really considered that the federal government could downsize like this, like some of these other things. But so I'm completely used to this. It shows up the most, I think, with oil and gas, and you kind of touched on that. When oil gets really, really, really expensive, then you start to see oil exploration and kind of boom and bust going on in some of these markets. We saw that up in North Dakota. We certainly saw that down in Midland, Texas, and some of those other markets. And then, of course, when it starts coming down again, they'll start to shut down. And so you see these boom and busts all over the place. As a real estate guy, I always watch for this. I never, in my wildest dreams, would have guessed that it would be the federal government.
Well, and people on here are asking, what about Southern Maryland? What about Virginia? It just depends on how many of those people are employed by the federal government, what other industries that area has going on. DC is very much affected because it does not have very many other industries. But I'm not sure, you have to look into your own markets like Southern Maryland, parts of Virginia, etc.
But it is something really smart to look at. First of all, if you're going to buy, make sure that you're asking those questions, right? If you're going to buy an office building, or you're going to buy something, even an apartment building that's filled with federal workers, it's just a box you need to check. If you own something like that, it's probably not a bad thing for you to dig in a little bit more, because the people who are renting from you or leasing from you, if they are these kinds of federal workers, that is jeopardy. You put that income in jeopardy potentially if they're leaving, or maybe they're just concerned. And I think this is again, there's a lag effect here, right? They're contractually bound to you. They're going to give you notice. They're going to not renew their lease. These things are going to show up over a period of time. But what's really, really interesting, and the reason we wanted to talk about it today, it's like the canary in the coal mine. Listings doubled.
Yeah.
Listings doubled. That's not a prediction. Like, that's real. So listings doubled and prices came down over 100,000 on the median. Which can be skewed, because it might mean that there's a lot of lower priced homes that also got listed, but it is the median from just from a little over a month ago.
But this is where you see that seller effect, right? The seller panic, right? So now anybody in DC that was considering selling their home that has equity is going to start listing their home, because they're going to be like, oh my God, if I don't list it now, then I'm going to miss out on all my equity. So then that's going to continue to flood the inventory. And we've seen this in Florida after the hurricanes. California is a little different, because a lot of people just moved to Southern California, and their market's doing okay right now. But you're definitely going to see people start listing in response to the kind of panic selling, right? So will that spread nationally? It depends, right?
Well,
it's kind of hard to know.
Here and there.
Yeah.
It definitely is going to. I think the interesting thing is, one of the things that I didn't get with the Southern California fires was the kid piece, right? And I have kids, but they're not in school, right? And so what we started to see here, which is very interesting, we had not far from our office, we had a buddy of mine that his kids are in a elementary school, and they said there are 5 families that from California that applied that week to come because of the kids didn't have a school to go to. So you there's other things at working here. There's cross currents going on here. So if somebody loses a job, think about all the stuff that goes on there. They got the family, they got the kids going to school, they've got their lifestyle, they've got maybe some other family in other places, and they have an opportunity. So all those things are happening at the same time. It's not just the fact that they lost their job.
Well, and it's interesting with the kids in the schools, because that would be an interesting tracking marker, because a lot of this data doesn't come out for 1 to 2 years, like how many people are moving to Arizona from California, or how many people are moving to wherever from DC. But if you start to look at where kids are relocating, then that's a good metric to follow,
Without a doubt. I mean, a lot of people obviously aren't in that scenario, but there's a big percentage that are, and that was something that I'd completely missed with Southern California was, now it's a little different. They don't have a home to go back to, a lot of them.
Yeah.
So that's different. But in this particular case, however, you start to look at those kinds of things. If somebody lists their house to sell it, they're serious. Right? They're serious. I mean, that means that they're moving their kid probably out of that school system, or they need the equity.
And Tim from YouTube brought up a good point. He said, we're seeing numbers of federal workers, but what we're not seeing is the total impact as federal contracts are rescinded.
Oh, good point.
Because that's going to be a whole nother thing. I mean, there's people that own businesses that their main client is the federal government, and then they employ a lot, of people through that.
That's a heck of a good point.
Mm-hmm.
Yeah. So think about this, guys. As they start to eliminate the federal workers, they're going to also start to eliminate the federal contracts, that actually provide income to either people or businesses, right?
Right. And I thought this was interesting. This morning we spoke with George Gammon, and he'll be on our podcast on Thursday. And if you guys want to check out our podcast, it's the Ken McElroy Show, and that is on Thursday mornings. And any podcast app will work, but there's the QR code. But we were chatting with him about the housing market, right? And I thought it was really interesting because everybody is waiting for this housing market crash that may or may not happen. And George was kind of saying that if rates go down and if home prices go down, it would be because the economy is not in a good spot. And something like this could kind of trigger that recessionary thing with the federal workers, right? But also, it's super hard to get lending if the economy is in a bad spot. So unless you have cash to buy your house, even if you paid a little more now, you might be in a better position than if you wait for prices to go down 20% and nobody can get a loan.
Yeah, one of the interesting questions I asked him was the federal funds rate has gone down, as we all know, right? It's been going down. Not a lot, but quarter point here, quarter point there. And that's been good. Then why has the 10-year treasury gone up?
Right.
Okay, so
which the 10-year is what they really do base the rates on more than the federal funds rate.
Right, because everybody thinks that the federal funds rate, and he said, here's why. I thought this was a great question. The federal funds rate actually is the one that makes the economy inflationary. So when it goes down, people buy more stuff. It creates inflation. And because there's inflation, and we saw this, the inflation numbers came out last week. They went up. Then the 10-year is really, he said, a derivative of what the economy is doing. It's not necessarily tied together. So the 10-year, everybody wants the 10-year down because the 10-year is what refinances and buying houses and all that kind of stuff.
Yeah, it keeps the rates up.
Correct, right? So, for somebody that lives and breathes with that 10-year personally, it's important that it goes down because it was in the mid to high threes in October of last year, and now it's in the mid fours. So it's a full point higher. So just imagine on some of these big loans, 10, 20, 30, 40, and $50 million, 1% is a lot. So it can make a deal or break a deal. And so, and by the way, this is a really interesting time because typically the Fed can lower the federal funds rate, and the Treasury typically follows. But in this particular case, it hasn't. So it's really something to watch. And so what Danille's saying is, if we start to have a bit of a crack with more supply, for example, as a result of something like this, which I can't imagine that it would be that impactful, but you never know, we could potentially start to see a reduction in that 10-year.
Yeah, but that just doesn't mean, if we were to see the reduction in the 10-year per George, and I think he's right, it means the economy is not in a good spot. So banks are tighter, lending's tighter. So kind of, you have to be careful what you wish for in this stuff. And, we always tell people, don't try to time the market, as long as you can afford the payment. And then if rates go down, you can refinance out of it, right? But just make sure you can afford that payment. I know, I follow the Phoenix market really closely, and our sales our prices are a little bit higher this year than they were last year at this time. So people are kind of under this misconception that prices are going down.
Well, that's in the high end here.
Yeah.
What's interesting in the Phoenix area specifically is I think we're pretty affordable when you start to look at other markets, right?
Right.
And so people come to Phoenix and they're like, oh my gosh, a home here is a bargain, right?
Right.
And if you've lived here for 10 years, you don't think that way.
Right.
But if you're coming from somewhere else, you do. And so I think we have a little bit of a run here personally in the higher end homes. What's not moving is the below 500s.
Correct. Yeah. The below 500. So you basically have, and I think most people realize this, right? Like the people that are invested in stocks and real estate and sometimes crypto and assets that are going up have money, where people that are just relying on their paycheck are struggling because of inflation and all of that. So things in the Phoenix market over 500,000 are still moving quite quickly. It's things under 500,000 that are sitting on the market longer, maybe have had a price decrease, things like that, because there is this divide, and I'm sure everyone listening feels it, because the people the last few years that have been invested in the stock market, the real estate market, the crypto market, they're fine. They've made way more money than inflation, right? But the people paycheck to paycheck, relying just on their salary, even if they're saving money, they've been squeezed. And that's why you're seeing these lower priced homes, sitting longer, where the higher price stuff that you would think would have the issue selling is having no problem selling.
Right. And I think this is the beginning. We wanted you guys to take note and just watch your particular markets, because as this starts to roll out, I do believe you're going to start to see cuts throughout the nation.
You will, but then you also, if they, like George was mentioning today on the podcast, if they can get rid of some of this regulation and they do bring more industry back into the U.S., there will still be jobs. So the whole goal, I think, of what Trump is trying to do, I think, you never know, but is trying to decrease the federal workforce and increase the private workforce. So, these other people might still have jobs. They just might not be with the federal government, but that's still going to impact D.C. because they're probably not going to be in D.C. either.
No. That's why I think this is probably going to be, I know a lot of people, D.C. is super unaffordable for a lot of people. It's expensive. The traffic's nuts. Boy, the last thing you want to do is try to navigate yourself around there. So we do think that hopefully you'll see a little bit of relief there, but I think DC is going to be in some trouble here. Again, with a lag on the housing front. There's going to be a lag here easily that's going to probably show up late this year, early next year. I mean, things take time. People are they're in rentals. They're listing their house. Their house is going to be on the market longer. They're going to be looking for jobs. All of those things, all of the above. They're going to be trying to figure out how to put the pieces back together.
Yeah, absolutely. And it's just going to, now we did talk about foreign investments, and I think that is something also interesting to watch for. If there is any kind of decrease in the DC area or in other areas of the country, our dollar is strengthening against the other dollar or against the other currencies right now. So the U.S. assets are a safe haven, the stock market, the real estate market. So you may see an increase in foreign investment too that could wipe away all of this as well.
So if you live in the U.S., this is not how you typically think, but for those of you who are outside the country or have been outside the country and have experience investing in other countries, you see the U.S. just like another housing market, No different than if you're in Phoenix and you decide to invest in Las Vegas. It's, and so if you have all your money in Canada or Mexico or Asia or Europe or wherever, and you're starting to look at, and you're wealthy, where do I stick my money? Hands down, the U.S. still wins. Period. Right? It's still the best place to park cash. It's still the best place to buy assets. And what we do know is that the dollar, I think we reported this on a live a couple of weeks ago, was at a 13-year high. 13-year high. I just want to say that again. So when everybody's talking about printing, the dollar is at a 13-year high. So how can that be? There's all kinds of reasons. I would encourage you to go back and listen to that podcast that we did. But when a dollar is at an all-time high and you're sitting in yen or pesos or whatever, you're going to start to take a look at, if you have the means, maybe I should be investing in the U.S. And I've been through this before. You guys know I've been investing for well over 30 years. So I've watched flows come in and out of the country. And the reason that they do that is because they're trying to create a safe haven for their own money, especially if they're having problems in their own economy. Right? We saw this in Japan. We've seen this in China. We saw this in Mexico. And so, it's just something to watch. There's a prediction that foreign investment's going to get pretty heavy here this year and next year. And I think that's probably true.
Yeah, because as other currencies are worth less than ours, and they're having to try to secure their money. And these are the wealthy people in those countries, not the people living paycheck to paycheck, but they're looking to somewhere to store their money. And, you've heard of that. People buying buildings in New York City and not even getting a renter in there because they don't care about the renter. They don't care about the cash flow. They just want to store their money in something that will be in dollars and appreciate in dollars.
That's the issue.
That's the only thing.
Guys, like if you're sitting in yen and the dollar's getting stronger, where's the best place for you to be? Period. Right? I'm not saying the yen can't come back, and certainly they have a central bank, so they can print too, and they do. But at the end of the day, you start. This is a big game. Oh, nice, Jerry. Thank you. There's your dollar, guys, right there. That's the U.S. dollar. So you can see. Do you have the chart down below? Yeah, take a look at that.
Right there.
Click it over to the 5-year, Jerry, down at the bottom there. Yeah, click on that. Let's see if we can do that real quick. Oh, there we go. 5-year. Okay. So it was pretty high, as you can see, in mid-22. That would have been COVID. Yeah. But before that, you can kind of see. Now, this is a really important thing to watch. And so just something to keep an eye on, because typically when the dollar's strong, we start to see foreign investment. All that means is that you could be competing. Before it was Wall Street, maybe buying homes, but now you could be competing potentially with foreign investment too, which is not necessarily good, but it is something to keep your eye on.
Yeah, and Ryan said he just pulled up the DC numbers, and median sold last year was 605. This year it's down to 551. So it looks like prices just based on this were down 10%, and also sales are up as well. So,
yeah.
So it'll just be interesting because all these people that are listing also might be buying. So you can't, you know what I mean?
Yeah.
Like a lot of these people, if you have $1 million house, you're probably not going to turn into a renter.
That's a really good point.
So you're probably going to buy somewhere else or maybe in DC.
And by the way, there's probably significant equity in a lot of these people's homes, right? Mm-hmm. So this is a good way for them to take some chips off the table. Question is, what are they going to do next?
Yeah.
Right.
So it'll be interesting to watch all of this.
I can't imagine they're going to go parallel at higher interest rates, right?
Right.
They're not going to buy something nearby, although some of them might be. But at the end of the day, this is the equity trap, right? They're going to try to get as much cash as they can, which you can't blame them.
Yep, absolutely. And we will see you guys next week, every Monday at 11.
See you guys.